Hey, it's Josh Young with Bison Insights. So, there's a topic that I've been writing about a little bit recently about the big advantage for the small investor. And one of the biggest pushbacks that I've gotten over time has been that there's an efficient market and that it's impossible over time to outperform in the public markets. And I have this book by David Swenson behind me who wrote whole books and papers about this, and many professional allocators, people that invest money on behalf of very important institutions like universities and pension funds, and in some cases, sovereign wealth funds, invest based on this theory that there are efficient markets, and therefore one should put money, if one wants to, in public markets in passive indexes and ETFs, and that these allocators should invest, and that essentially private individuals too should invest in private markets where they argue there is less competition and more mispricings and therefore more outperformance. And so I saw this commentary recently by maybe the most famous or one of the most famous energy investors ever, who, when I was starting my investment firm, I had the privilege of having drinks with. Me and him and my former business partner who helped me co-found Bison Interests, my investment firm, for which this is not an offer, solicitation, or recommendation. And it still sticks out to me that we had a debate over drinks about the availability of outperformance in public markets, again, tied to this question of market efficiency. And this extremely successful and famous energy investor argued that there was just not that availability for outperformance in public equities. And incidentally, I posed to him one example of a company that I had identified that at this point, I think this was in early 2015, was materially undervalued relative to its intrinsic value. And because it was a small cap security and misunderstood, people would not be able to price it correctly. But it was big enough, and it was something that I knew that he knew. And it was fascinating because he agreed with me that this individual stock that he happened to know was very undervalued, but then he still doubled down and posited that it was impossible to outperform versus the sector even in public equities because of the efficient market hypothesis. Again, ignoring that his success had been so substantial in trading in the space adjacent to this. And so it's remarkable because I'll identify the company because at this point it's so transformed that maybe it's not true anymore. It's SM Energy. And so I think it used to be called St. Mary's. I think right around when we were talking, it was in the process of changing its name from that to SM Energy. And over the course of what's been now almost 3 mini cycles, this stock has gone from, I can't remember what the stock price was at exactly, but I think, at least doubled, maybe it quadrupled from when we met until its local high. And then it fell to something like, let's say, $5 a share. And then it went to 50 and then to 5. And recently now 37. And actually, I got to hear their CEO speak at a recent conference. And I had a small, equity linked security linked to their stock. And I actually exited most of it while listening to their CEO talk. It was sort of a reminder that, hey, this thing has moved a lot. And then also that they've sort of gone further along on sort of this ESG agenda. They were very concerned with things other than corporate profits, which is not aligned with my concern as an investor, both for my clients as well as for this Bison Insights newsletter. And so it's one of those really remarkable things that even people who have made inordinate amounts of money for themselves and in some cases for their clients will still argue vociferously that it's impossible to earn outsized performance in public markets, and will aggressively ignore the nuance of the research, where no one says, for the most part, from an academic perspective or a practitioner perspective, that there is not outperformance on the edge of markets. That the efficient market hypothesis, to some, is sort of this almost religion, when in reality, the hypothesis itself, the way it's structured, conversations with the folks who came up with it, who I studied with at University of Chicago, they do not believe that. They believe that markets are generally efficient, but just like many of the economic theories that have been promulgated from the University of Chicago, they are misunderstood. It is not the case that an economic theory that postulates something means that it is true in all cases. It reminds me a little bit. I got to hear Professor Coase, who's no longer with us, speak at the Coase Lecture, which is the most prestigious lecture at University of Chicago Law School, where they talk about the intersection of law and economics. And he got up and ranted about this subject related to the Coase theorem, and was so upset that people were taking his thing, which is similar to the efficient market hypothesis, and they were just taking it literally and not taking it seriously. And the reality is that, just like with the Coase theorem, that you don't want to take it to the extreme. I would argue that on the efficient market hypothesis, the folks that say no stocks are inefficiently priced, and that stocks in an out of favor sector that are of a smaller size cannot be persistently mispriced and arbitraged. I think those folks they're just not reading it and they're not taking it seriously. And in many cases, I've found that they actually have sort of very aggressive agendas. So whether they run a private equity firm and are seeking allocations there, whether they're allocators who are personally incentivized to allocate to private funds where volatility is mitigated or suppressed because of infrequent reporting and mark to model instead of mark to market, or whether they are phenomenally successful and maybe are trying to pull up the ladder, similar to, like, let's say Soros, where they go out and push for, socialism and aggressive regulations to prevent the level of success that they achieved in markets. There's a variety of different motivations for this, but it is pretty incredible. And I say this maybe with a little more data at this point, where not only from a theoretical perspective should one think, upon careful reading of the efficient market hypothesis and various research, that it is not only possible but likely to be able to, with sufficient information and effort, expenditure and time expenditure, to be able to generate outsized performance in small cap stocks in out of favor sectors like oil and gas. But it's also been accomplished. And so again, none of this is an offer, solicitation, or recommendation. The goal is to help, for informational and educational purposes, explain the real world application of this theory, despite the billionaires and the ultra famous folks and the people controlling the keys for the money at these endowments and foundations that ask us for money and donations all the time, and then allocate in a way that's sort of very maybe not aligned with how you or I would actually invest our own money. And the point is that, in reality, since that conversation, for my investment firm, the investment firm is up roughly 200% net. And the sector that it's benchmarked against is down 55% net, as measured by the ETF. Similarly, Bison Insights, the composite that I've constructed to track the performance of the ideas. There have been individual ideas that have underperformed. One in particular, it's been very annoying. It was a small idea with a 2% weighting in the composite, and it's fallen to below 1%. Very painful and annoying. Despite that, the composite is up more than 100% since Bison Insights launched a little more than a year ago, versus the sector being up close to 50% and the market being up close to 20%. So it is not only possible to have outperformed over a long duration shortly after that conversation with that perhaps most famous living energy investor, in which he acknowledged the specifics and then still vociferously argued against the principle and refused to be helpful or supportive or anything along those lines. And then reality, which is 11 and a half years later, material outperformance. And again, there's sort of the absolute performance, but there's also the relative performance. And there's the principle of it, which is that it is not only possible, but it is totally achievable to materially outperform in oil and gas stocks, as well as likely In other subsectors, however, I did not participate in those others, just in oil and gas stocks. It has been possible to materially outperform to, the extreme, let's say, negative pushback from, again, all of these different folks that have different sort of incentives and different reasons to not want this to be the case, whether it's personal or financial or philosophical or political. Um, and it's been possible to not only do that privately through a private investment firm over the last 11 and a half years, for which this is not a solicitation. The whole point of this is to explain this theory and to explain what I'm up to with Bison Insights. It's also been possible through the publication of 17 individual stock and related security ideas over the last 12 and a half months, almost 13 months at this point, to be able to more than double the performance of the essentially benchmark ETF. And of course, it's imperfect. It's not net of fees and it's not net of transactions. And these aren't specific recommendations. They're just ideas and they're tracked from the unaffected price from the day before publication. And yet, there's been this massive outperformance of these ideas. And I saw something this morning that reminded me of this, and I'd like to continue to tell stories and share experiences of specific companies and specific interactions that I think maybe help frame the opportunity and explain why it exists and sort of negative perceptions of it. And essentially, in finance, a lot of the things that work really well, at least from a public market perspective, are public markets. They call it climbing the wall of worry. And I think we're seeing that right now in oil and gas stocks. And I think we've seen it for the last many years in terms of both this inability to accept the potential of outperformance in public equities, particularly in the areas where probabilistically they are most likely to occur. Again, when you look at Fama French and you chat with the folks that are doing the research in the space, you would not be surprised by this. But if you just sort of read the common literature on it in the news and from sort of the big folks that benefit from people not doing this, you might think otherwise. So anyway, it's pretty remarkable. I thought you might find this interesting, and so I thought I would hop on for a few minutes on a Sunday morning after seeing some public takes and some perspectives that reminded me of this, and I thought I would share this with you. And I hope to share more similar stories about my journey and about what goes into the process here at Bison Insights, as well as what went into my day job and the tremendous success of Bison Interests despite enormous obstacles. One other thing I'll just point to for a second, which is that in most other sectors, the folks that have left the sector that, have retired or have, sold their companies and are advisors, they put meaningful personal capital into the space via both funding private deals and investing in public equities. Oil and gas is so hated and so out of favor. It's remarkable. It's one of the few places where there are very few ex-industry folks who are actually investing into the space. I think it's one of the drivers of this mispricing, where you have energy stocks at, let's say, 3% or 3.5% of S&P 500 by market cap, but 10 or 12 or 13, somewhere up there, percent of the earnings of the S&P 500, and similar in terms of contribution to the US GDP versus market cap. And so pretty remarkable how much hatred there is, and then pretty remarkable how variant the understanding is. And again, it's in line with people's incentives. Expecting them to behave and respond to against their incentives is maybe too much to expect. But I think it's interesting that there is this opportunity, because it's in the face of all of these negative incentives, to be able to find stocks and related securities that can meaningfully outperform both the sector and the broader market because of this big advantage to the small investor. So again, none of this is an offer, solicitation, or recommendation. Not everyone may have achieved the exact returns that I cited. actually exciting from Dyson Insights because of the nature of it. From what I've heard, a number of subscribers have actually done much better than that composite number that I've shared. So that's actually quite reassuring. But again, past performance may not be indicative, and others may have had different experiences. I'm going to close it up here. Thank you very much for joining. Take care.